Morning. Yes, I'm Glynn Tonsor. Maybe the brightest talk you're going to get because I get to talk about the cattle market. That's not always the case. But to go further with that, my colleague, for those that can't see this on Zoom, Dan O'Brien walked in and he's carried in a hard hat. So that seems very fitting that he's going to have to wear a hard hat during his talk and I'm not. But no, it's a pleasure to be with you guys. As you know, these slides are going to be available. You have a version of them now. You'll get the final version on Ag Manager. I tell people that out of habit because you're welcome to write anything down you want, but you're going to have full access to this later. So I'd rather you look at me and us go back and forth and converse than worry about third decimal point on something here. My first two slides, and I almost always start with something like this, is basically give you the P's and Q's, right? Like the best forecast we got, and then give you a lot of detail in between and put a bow on it on the end. This is information from LMIC, and this is not the LMIC based here in K-State. It's one out in Denver, so Livestock Marketing Information Center. K-State, Oklahoma State, lots of land grants, the USDA agencies and so forth are members of that group. In a lot of ways, they're a data aggregator, and then they do their own forecast. I find it very helpful to bring their information to you and then add my own commentary and color to that as we go. So that's what you're getting on these first two slides is their projections. Each row on these slides is a quarterly time period. And then we have 25, 2026, 2027 as you move from the top down. The yellow is a calendar year. And of course, basically 3/4 of 25 is now in hand, and the rest would be forecast. To put a bow on this, the arrow is down because to the far right, when you're looking at this, is we're experiencing declines and we're expected to continue to expect declines in domestic commercial beef production. On the left-hand side of this slide, you'll see the commercial slaughter. So think hoof count going through the system, federally inspected slaughter numbers. Here this year, we're expecting almost a 6% decline compared to last year. Looking out to 2026, maybe a 5% decline, and then an additional 4.5% the following year. That's sort of guaranteed because a lot of that's driven by the calf crop and the number of cows, so forth in the past. The part that's a little bit of a moving part, and it's mitigated some of that so far, is the middle, the dressed weights. And particularly in 2024, we pushed up dressed weights a lot more than we expected. So in 2024, we actually produced a little bit more beef than we did the year before, despite the fact we had fewer hooves. And it's because dress weights were enough higher from Q2 on in 2024 that actually total beef production was up a little bit. We're not going to have enough of that to offset the hoof decline here as we go forward in 2025 and forward. But I do want to interject that because we ended up producing more beef than we thought we would in 2024. And it's possible that trend continues, right? There's these positive year-over-year increases in dress weights that are up here. Cheap grain, which back to Dan's hard hat, isn't fun to talk about from that perspective. But it is supportive of these higher dress weights, right? I mean, that part's connected here. But there's an expectation those rates of gain on dress weights are going to moderate some, and we still have a net less beef being produced. I will impress on you that the beef production part of this is what's to think through more than the hoof count from an aggregate economics. Like the industry works backwards from the amount of beef that the world wants and what's it valued at and demand signals and so forth. There's individual considerations on hooves in terms of like running a plant if I can't keep the plant full. But in terms of the aggregate economics, it's more useful to think about beef than it is actually cattle. What about the prices here? Again, moving left to right here, you have three different weight classes. Fed cattle, 5 market average, followed by Southern Plains yearlings, and then finally the calf market. All of these are up. Everyone in the room knows this. I have a price chart for each of these. I'll show you in a minute, kind of to break down 2025. But I'll jump ahead to 2026, 2027, and let's just do the calf market for simplicity for a second. That is far right of this slide. LMIC is projecting a small increase in the 2026 price. So the calendar year they have up there is $4.19 to $4.31. That's up from basically $4 is what they have for 2025. I verbally will interject here that if beef demand stays the same and Mother Nature stays the same, and those are two big ifs, you need to put in capital letters and underline like 14 times, but if those two conditions hold, I think we'll start pulling heifers out of the system next summer. I mean, I think that's when we'll actually see some realized effort on expanding. And if that's true, we'll have fewer heifers going through the fall run of calf crop. And if that's true, I think this is too conservative a price, given where we are today, okay? So if I was to comment specifically on LMIC's forecast, if the conditions today hold, you heard my ifs, I actually think the calf price next, Q4 next year will be higher than what's on that slide. Now there's massive risk behind that statement, but if there's one on here I was going to point to that I would actually give you a different number, I would add 30, maybe even $40 to what's up there if in fact we pull some heifers out of the system, okay? 2027, kind of more of the same in their forecast. And you can see the yearling and the fed cattle markets are sort of following with these small, but yet additional price increases being expected. So now let's go cow-calf towards the consumer, right, or farm to plate. It is not a new statement that we have fewer mama cows than we did last year. There's a lot of discussion about where we're at in the cycle, and we're going to talk about that, and I think we will bring some back. But this is a long-term trend I think is important to remember. So going back to 1995 is what's the first value up here. USDA in their January cattle inventory report gives an estimate of the number of beef cows. So the mama cows in the system. And you can see back in 1996, we started the year with 35.3 million beef cows. And I purposely put a trend line in here across 3 different cattle cycles in this particular chart, long-term decline, okay? The more recent peak was in 2019, which was 31.6 million. We started this year below 28 million. And the question is, right, what will it be the next 5-6 years? When will we start expansion and so forth? I like to start my comments about expansion with this slide because we don't need as many mama cows to produce any beef production target today as we did 10 years ago, and certainly as we did 25 and 30 years ago. The cold hard economics of efficiencies is what's driving this downward trend over time in a lot of ways, right? So it starts on the ranch, more breeding success, more calving success, lower mortality before we even send them forward, right? All the way up to those dressed weight comments about being pretty common to sell a 1,500 pounder now. So there's more animals per steer and heifer. When you add up all of that, we're getting a lot more beef at the end of the day per mama cow in the system, which is efficiency 101 for the industry as a whole. But if you heard my earlier comment about the economics start with beef, not cattle, we don't need as many beef cows to hit any beef production target today as we did 10, 20 years ago. Why am I impressing on you? I think we're going to expand the herd, but I'm in the camp we won't break that previous high of 31.6 million. And to be very blunt, if we do, the amount of beef that comes with that is going to be a lot more, and it'll put quick downward pressure on calf prices unless we continue to have demand escalate to kind of buy those cows into the system. And that'd be great for the industry, but you're hinging on additional demand growth for that to make sense, if that's the case. And basically, I'm betting that won't go on forever. So at some point, the signals will be, don't keep expanding. This long-term trend will be the norm again, is really what I'm trying to say, okay? Best forecast. For yourself or anybody you're working with in the lending community, we have this resource called Beef Replacement Tool. Kevin Duvetter originally built it. Myself, Robin, and others maintain various versions of the Excel decision aids. Please make use of it. At the end of the day, it just gives you a net present value of adding a female to your herd, right? And you can use it for a replacement that might give you 8 to 10 calves. You can use it to value a 5-year-old cow that might give you 4 to 5 calves. I mean, you can use it in various ways, but it's just an emotionless, data-driven, right, net present value calculator. Importantly, it is not a predictor. So do not use this to predict what the heifer market will be. And to make my point, if I'm correct, next summer we start expanding, I think for 2 or 3 years, any number you get out of this will be $1,000, if not $2,000, lower than what people are actually paying for heifers. And that's what I mean by it not being a prediction tool. It's not designed to be a prediction tool. If I wanted to give you a prediction tool, I would put in some kind of irrational exuberance component from the cow-calf sector, because every time in the past when we pull the trigger on expansion, we do more than any emotionless net present value would tell you to do. But I think there's still value in doing this because you can see sort of what's driving, will this asset make sense or not? What expected rate of return am I baking in if I pay $1,000 more? It will tell you that, just like reverse engineer from the net present value. But I want to be very clear, it's useful to compare. If I expect this on calf price and I have this annual cost to run a cow, and this is my discount rate and those kind of typical investment decision factors here, what's the net present value? That's what it gives you. And then you're more informed when you make the decision. But I fully expect the heifer market is going to run ahead of these kind of tools for the next 2 or 3 years. It has every other time we pull the trigger on expanding the herd. I think this group can appreciate that distinction, but it's important to keep in mind. All right, so we have 3 slides that look like this as we go through. This is the calf price slide, specifically Southern Plains. The solid blue line on top is the current year. The darker or almost black dotted line is last year. And then the prior 5-year average, which is kind of irrelevant now when you think about the scale difference in the cattle market, is the red line at the bottom. I've been trying to describe and get people's eyes to look at the wedge growing in this year's prices versus last year. So when you move left to right from January through now that September is complete, yes, there's a couple weeks the statement holds, but on balance for the year-over-year price increases have just grown. You guys can kind of see that visually, right? So the market in a lot of ways has been bullish and more bullish than last week. And the best thing you could do if you're a seller was wait one more week. There's a signal from that, like in the very near term. That won't go on forever, but that's been how 2025 has played out. And I'm interjecting it because old rules of thumb on seasonality and so forth don't work well in this kind of market, right? There's a lot more than just seasonality going on here in 2025 that we can talk about in Q&A, but you're going to see this on all three of these charts. I'm going to give them for three different weight classes, is that year-over-year gains have just kind of grown for the most part as we went through this year. And you can see we've added well over $100 per hundredweight to every calf compared to last year. If you want a projection in the future for the calf market, I have a beef basis slide 3 different times in here. This would be for, most of you probably know the most common thing is we have a fall calf run. The most common situation is a cow-calf producer sells a calf in the fall. So we're getting ready to see that in lots of ways. So the Salina market, somebody's going to sell a 6-weight here in the middle of October. You can use the beef basis resource to come up with a projected cash price. What's beneath that is the prior day's CME feeder cattle contract and historic basis for whatever scenario. And here the scenario is I chose Salina, I chose steers, I'm doing a 100-head lot behind the scenes when I run this for you. I mean, I'm picking those kind of things, and you get this forecast. And you can see 411 is the number that comes out of that, and that would reflect last night's close. So this morning at like 6:30, when I ran this again, it was the CME close last night, all the past basis relationships, this is what you get. The $4 calf is a good price historically, right? So keep that in mind as we talk about profits. LMIC has their own barometer of profitability. This is a bar chart that goes back to 1998, and it's their estimate of returns over cash cost. Most in the room can remember 2014 being historically, noteworthy year in a lot of ways. The number there for 2014 was 534. So LMIC's, effort, their calculations here suggest that in 2014, the typical U.S. cow-calf producer made $534. If I sat in front of you last year, and I probably said this, I just haven't watched the recording. Last year, we had not yet broke the 2014 returns in inflation-adjusted terms, because we've had roughly a 33% increase in all things over that decade, right? Depends whose inflation number you use, but you can just use a third as a good rule of thumb over that decade. A lot of that since the pandemic, but nonetheless, over that 10-year period. Now that comment's not accurate. So looking at 2025, we're now at a point where we're expecting returns in real terms to be higher than they were in 2014, okay? I'm interjecting that not because I think everybody only makes decisions compared to 2014. Don't overreact to that. But there is, I think, some mentality to 2014 was really good. I've got that in my back of my mind. How's the current environment compared to that? There are some producers that think that way and think through it. And we do have a more bullish profitability situation now than we did in 2014, okay? Specifically, you'll see a 906 up there is the current forecast for returns over cash costs for this year. Randy Block last week at the CAB conference projected 820 or 830, something like that. So exactly what cost numbers you're using is going to change this a little bit. But to be blunt, even if you take $100 off this, it's still a good year, right? And I don't willy-nilly take $100 a cow away from anybody. Don't overreact to that. But the magnitude of increase in profitability is substantial. So it's of note. You guys knew that when you walked in the room, but here's the numbers with it. And LMIC is expecting the next 2 years to not be as good, but by historic standards, still be quite good. What about yearling market? This chart should look very similar to the calf slides, just not quite as steep. So the year-over-year gains aren't quite the same rate, but that wedge is still growing as we move left to right. So the same mechanisms of we're chasing cattle a little bit more as the year went on, they applied in the yearling market as well. And here we again have over $100 per hundredweight higher prices last week than we did the year before. Whether you're a cow-calf, stocker, backgrounder, anybody that's in the position to be selling feeder cattle, you can, if you want, make use of this feeder cattle risk management tool. And it should really say price risk, because that's the only part of the risk we're examining is output price, sales risk. You can use this tool to compare, I say the do nothing, so sort of the cash approach. It's kind of a default compared to the CME, futures hedge, CME put options, LRP product, which Jenny and others have talked about at length before. This tool is designed as another Excel decision tool to help you see how the expected net selling prices compare across those alternatives. It's not meant as an advertisement of any of those alternatives. Rather, in this quite elevated price environment, there's a lot of discussion about, quote unquote, should I lock in a floor, right? Comes up. This is a resource you can use to kind of see how those different approaches would look, given current margin cost and so forth. You plug all that in, and there's a fancy chart that comes out that kind of shows you how they compare. 2 more slides from beef basis. So again, we're moving from cow-calf towards the consumer. So kind of the next stage is the backgrounding and stocker segment. Once we get off the cow-calf ranch, the basic economics are the value of putting weight on relative to the cost of putting weight on, right? And you can do this per head or per hundredweight. We can do it in different ways. One backgrounding exercise is, what if we take that calf I just talked about from the middle of October and own it longer? So hence maybe I just retain my own and don't sell it then, forego selling it in October, or I buy somebody else's. So that's why I have this buy or retain, right, is where this one starts in the middle of October. And then I sell that animal weighing 125 pounds more early in January, right, the 14th. You can plug that scenario in, again, to beef basis. What will come out is the same buy price, that 410, should look familiar from before. And then the sell price at a heavier weight out in January is 368. The math of those two, you can put that out on a $1 per hundredweight or a $1 per head basis, right? $201 per head is the projected value addition that comes from this. You compare that to the cost of doing it. So if your costs are below $200 and you're comfortable with all the risk, in this environment, pull the trigger on that is the way you use this, right? So this tells you nothing about cost. This is just the value of gain part of that decision. You got to know your cost to do that. But I encourage people to use this resource to do exactly that. You can redo this and say, what if I supplement and I push that animal to 750, right? You're going to sell a little bit heavier animal. You're going to change the sale weight, but you're putting more pounds on. How's that change, right? Those kind of scenarios is what, like at Stocker Field Day last week, that's what I was walking folks through. What about the summer grass situation? So let's keep going further. In April, somebody's going to either retain their own yearling or buy somebody else's yearling, put them out on Flint Hills grass or other equivalent systems around the country with the goal to put a couple hundred pounds on before they get in the feed yard, right? And here's a scenario where the animal would leave in the middle of August, same exercise, put about 200 pounds on. You can see the kind of the production stuff, how much per day, how many days, so forth. The prices going in April, the price going out in August. What does that mean? The value add here is $338 per head is what's being projected. Compare that to your cost, right? And here the cost about pasture, rent, and so forth would all become quite important in terms of the total cost of accomplishing this. That's how you use that information. Those margins are pretty wide because the cattle prices are pretty wide, but a lot of people are underestimating the cost of accomplishing it, right? So keep my comment in hand here is this is useful of understanding the potential value or the market projected value of adding this weight. But we got to push the pencil. I would have always said that in front of a bunch of lenders, but it's extra important with this amount of money at stake. Last one of these slides is the fed cattle market, specifically the 5 market average. Now this one's slightly messier, but on balance, this wedge also grew, right, as the year went on. There towards the end of the first quarter, we had a little bit of a pullback in this market, but overall, that's the case. And we still have the comment that at least a $50 per hundredweight increase in prices compared to last year, sitting here as September wraps up. Now, what about the profit for the feedlot sector? This is a chart from LMIC back to 2016. The number I want to call out here, the reason I'm starting with this one, is their latest estimate is for returns in August. And their exercise, they estimate the typical feed yard in the Southern Plains had a positive $541 margin on an animal that left in August, okay? So one that was placed on feed earlier. One of the things LMIC does is has what I call a fixed production. So 750 pounder going in, and then I think it's 1350 is the presumed out weight that's under their exercise. So there's no adjustments in the weights in this calculation. And they presume no hedging. So you paid the cash for feeder, you paid the cash for grain as you needed it, you took the going cash rate for fed cattle, in this case in August. And if you're exposed to the market, you benefited, right? Because remember that price slide on the chart for fed cattle is just going up. So if you were exposed to that, you benefited in hindsight, right? So that's what gives you that positive, and I think it's accurate per that assumption. Here's sort of a parallel thing that I maintain here at K-State. So Justin Wagner is a faculty member in the Animal Science Department. Himself and some others are involved in something called the Focus on Feedlot Survey. So they survey Kansas feed yards, and that gives me some insights on production. So placement weight, sale weight, death loss, average daily gain, that kind of stuff. I marry that up with Garden City-based cost of gain and then what I think is going on in the Kansas feeder cattle and fed cattle market to get a barometer of Kansas returns. But 2 distinctions and important points here compared to the last slide. One is, if you heard me, we're letting the weights vary. And what's really important here is we're letting the sale weight be higher, right? Because for the last couple of years, we've been selling way higher than that 1350, right? And at the end of the day, we're putting more pounds on every turn in this exercise than the one before. But the part that's common to the LMIC series is I'm also assuming no risk management. So I'm also assuming you paid the cash price for a feeder coming in, you paid kind of the going rate for feed, and you took whatever the market was, like the negotiated market for fed cattle when you sold them. So it's a no risk management assumption. So this series also is more variable, both good and bad, than any environment where we're hedging. So you got to keep that in mind. And you're going to see that in spades on this slide if you follow what I'm doing here. So I put 2 boxes up here. The green one's more fun to talk about, but the estimate for September is a positive $700 return. So a steer leaving a Kansas yard in September that was fully exposed to the market, that benefited from that fed cattle price increase. And important in my story, if you're tracking me, we put 150 more pounds on in this example than the LMIC one before. That enables us to have a bigger positive statement because it was more profitable, right, per that assumption. The exact same exercise for animals that are now on feed that would be coming out in March comes up with a projection of a loss of $256. Okay? I've never stood in front of a group before and talked about within a 9-month span, nearly $1,000 per steer swing. And it's $960, right? But that's a big adjustment. As you move left to right on this slide is the different inputs into that statement. So I'm interpreting the total, the net return is where I jump to in my verbals with you. But as you move across this, we have the cost of gain, we have the components of fed cattle price, we have the placement feeder price, and the final 3 columns are kind of the break-evens if you want some indifference points on different parts of this margin. But I want to draw your attention, if I get the laser to work here, to the feeder price. So think placement yearling price. The animals that went in roughly 7 months before September were placed at $250. The animals that went in 7 months before March, so here later in 2025, went in at $343. That's the main difference, okay? As you look through these other components, the cost of gain, there's not a big difference. That's rounding error of relevance and difference in these kind of calculations. And even the fed price, yeah, it's $5 better, but $5 pales in comparison to the difference in the placement, right? So the margin pressure, if you're totally exposed to the market, is we paid a lot more for the animals coming in without the ability to hedge it on the output side. So even if you're hedging, the CME markets and others are not offering you an equivalent way to offset that, hence this massive differential, okay? So totally being exposed to the market is very, very variable at the moment in the feedlot industry. I will add, a lot of cattle in this country are not totally exposed to the market. Remember my comment about the variability in the series is a lot wider than reality for a lot of those steers and heifers, so keep that in mind. But in a lot of ways, you could consider this justification for that, right? Because that's what you're avoiding is these kind of whipsaws. All right, let's talk beef demand. One of my favorite slides. Got to be a geeky economist to like these kind of slides, I know, but there's a really important point underneath this. So horizontally, this is pounds per capita. So the amount of beef in the system per person. It's a disappearance estimate, okay? And I can tell you how we derive it if you want, but there's nothing about the price or the value of beef in that value. Vertically is where we get that information. So specifically, this is ERS, USDA's all fresh beef price in inflation adjusted terms. And each number that's up there is a scatter plot point or an intersection of those two for each calendar year going back in time. Now, if I can get my laser to work, 2024 is right here, and then I put 2023 in purple. Hopefully we can see that because I put the colors up there. Please note 2024's intersection is to the right and up from 2023. So the average person in America consumed more beef in 24 than in 23 and paid more for it in inflation adjusted terms. It's not just an inflation story, okay? Right and up. Any industry that can put more pounds on a market and realize a higher price per unit, I mean, that's like the pipe dream, so to speak, for an industry. That only happens with demand growth. The only way you get that outcome is for the demand curve to be moving in a positive way to support that, okay? So 2024 was clearly a good beef demand year compared to 2023. To really drive the point home, we had a little bit more per person of beef. This is not a supply story in 2024, right? We actually had more. Now, it was driven by dressed weights, not hooves, if you heard me 20 minutes ago. But the higher prices cattlemen got in 2024 was because of demand, not supply. Now, sitting here today, October 1st, the supply realities are hitting the market. We have less now, right? So now I would argue it's both supply and demand are at play supporting. But when you look backwards and we break this apart, demand was the story why you had higher prices in 2024. And we entered this calendar year with a good demand story is the point, okay? 2025 is unknown because we're not done yet, but current best guess is we're gonna basically be just straight above it. So similar volume per person, imports are offsetting domestic production on balance is what's underneath that, because imports are part of this total disappearance calculation, okay? And yet we're pushing the price even higher in inflation-adjusted terms. And I'm very confident it's gonna be higher because the price increases we've seen through 3 months are pretty much guarantee it's gonna be up. Exactly how far left and right has to do a lot with how imports play out the rest of the year. But there's a really good chance come January 1st, I'm gonna be talking about 2025 was another good demand year, okay? Fast forwarding what the scatter plot's gonna look like once it's up there. I talked at length about this in other places. You're welcome and encouraged to go to this link if you want more on it, but to save you from 45 minutes on it, I'll not do any more on that. The meat demand monitor is something that I run here at K-State. It's supported by the beef and the pork checkoff, and it's kind of a deep dive thing on all things domestic meat. We survey over 3,000 US residents every month. Literally an hour ago, I wrapped up the September report, sent it into the queue to hopefully get it reviewed. The current arena of government shutdown, I have no clue when I'm gonna be able to release it to the world. We can come back to that in Q&A if you want, but I have the September numbers in my head. I just can't show them to you until they're approved by USDA AMS. The most recent is from August, and these are just two of the figures. Every month we put out a 4-page document that's got 8 or 9 figures in it, and I pulled 2 of them out of here just to make a talking point. To the left is something called protein values. So what we're doing here is trying to track what drives the decision to buy meat protein or not buy meat protein. And every person, over 3,000 in the country every month, I'm asking one question. Here's 12 things, and you can read the list of 12, taste, freshness, all the way to environmental impact. Of these 12, what are the 4 most important in making your protein purchasing decision? What are the 4 least important? And the 4 you don't pick, I know are in the middle. So for each person, I know your top 4, your middle 4, your bottom 4 factors, okay? What I've done on this chart is summarize across the roughly 3,000 people, the summation of all that. And if you understand how I'm asking the question, it's 0 sum for every person and 0 sum for the whole sample, because I'm doing like a +1 score if you told me it's a top important thing. I'm doing a -1 score if it's the bottom, and I'm doing a 0 if it's in the middle. So for every person across these 12, it's 0 sum, because it's not, you can't tell me all 12 matter. I'm saying which 4 are most and which 4 are least by design. To interpret this, taste, and you're gonna know why I'm doing this to you in a second, that plus 0.43 up there, that's the value for August. In August, there was 43% more US residents that considered taste a top 4 factor than considered taste a bottom 4. Hence the big positive number, okay? Now to pick on environmental impact, just because it's on the other end of the scale here, there's 46% more people that said environmental impact is a bottom 4 than said it was top. And if you sum up those 12 numbers, they're 0. You guys kind of tracking how you do this? The reason I'm interjecting it, if you want my opinion about why beef demand has been so good, my comments about 24 being the reason cattle prices are higher and so forth, it's taste, it's taste, it's taste. So the public regularly tells us taste is the most important consideration. Price is up there, and you can see it's 3rd or 4th, depending on what month I do this. So price matters, but it's always outranked by taste and freshness. And beef in particular has a very good taste story that's been realized in the form of higher demand, okay? I could do that for days. You probably picked up on the excitement of my discussion there, but it's very good for the beef industry because they're capitalizing on that, okay? Now, the concern, or the Dr. Bayer here for a moment, is the other one, and it's this slide right here. So one other thing we do every survey, every month, is we include a couple of questions that are also in the University of Michigan's Consumer Sentiment Index. You see in the general media a lot more. And the real simple one I'm highlighting here is we're asking folks how your household finances compare now with a year ago. And in August, 20% said my finances are better than a year ago. 47% said they're the same, and the balance, 33%, said they've gotten worse. The part that's most important here, not surprisingly, is how much less you spend on food when you say your finances are getting worse at home. And the part I really want to drive your eye to is see how much steeper the away from home trade-off is versus retail. The first thing people do when they're worried about their finances is go to the restaurant less. And if I'm not walking into a restaurant, I'm not spending food and money in a restaurant, right? So this trade-off, it shows up in lots of data sets, not just the MDMs. It's been a concern of mine for months. This is not a new thing to highlight at all, but the broader macroeconomic uncertainties and so forth, and I'm sure Brian touched on them at length earlier, the relevance for the beef industry, like the immediate, is on this channel, okay? Because as people get concerned about their finances, much less they actually get worse, this is the first trade-off they make. They quit going to restaurants, okay? I included this, not necessarily as a commercial for Stocker Field Day, but it's a little bit of one. Last Thursday, I was at Stocker Field Day, and I'm really including it to give Lance credit for the next 3 slides. Lance Zimmerman is an economist at Rabobank. He and I gave a joint talk at Stocker Field Day last Thursday, and I'm going to show you 3 of his slides because I think you're going to see value in them. They sort of augment and confirm some of my earlier comments. And they go a little bit further, first one with a longer history. So Lance shared this slide, and it's a slide that goes all the way back to 1979. And this is him doing the same kind of beef demand tracking, but I'm bringing it to you because it's sort of mine because I do a similar calculation, but it is his and Rabo's. And the punchline he shared last Thursday is the current best guess for 2025 is we're going to end with a better demand environment than we've had since 1983. That's the punchline of what you're looking at, okay? Now it's a forecast. That's why the 2025 bar is different because it's not done yet. But why am I interjecting it here? If realized, and I 100% agree we're on track for that, like if the train wheels don't fall off here in Q4, we'll have something similar to that. This isn't about this cattle cycle. It isn't even about post-pandemic. It's multiple cycles, multiple decades. You got to go back to make this comparison. Beef demand is just in a totally different arena, right? And this is one way to make that point. If you got to go all the way back to 1983 to find the point where we're that good, right? There's been this general positive trend since the very late 90s. And there's been notable macroeconomic problems as we went. You can see that in times. But in aggregate, beef demand has been quite good, not just compared to 24 and 23, but for some time is the point of that comment. And I 100% agree with Lance on it. That's why I interjected here. Now, he also shared this data, which makes my restaurant concerns even more compelling, I think. Totally different data set because Rabobank has access to different data sets than I do and so forth. The punchline of all these negative bars is a decline in foot traffic and spending through restaurants. So we're seeing it. So the monthly meat demand monitor concerns on that I shared with you are very consistent with another data set. And we have challenges in the restaurant chain. His forecast via Rabobank for the size of the herd, because if we're going to expand the herd, how much? He calls 2025 the year of stabilization. What I really want to drive your eye to is all the way out to 2030. Him and Rabobank are projecting a little over 30 million beef cows. That's growth, but if realized, we'd still be quite a ways behind the previous high, right? Now, he's not projecting out to say 2035. I think he would tell you a little bit additional growth in the next couple of years, but that is, I'd say, cautious growth that's being projected. Last slide, I believe, is just helps me make this comment, is I'm going to something called the Data Users Meeting. It's in Des Moines in a few weeks. I've been telling everybody you got to be a real geek to want to go to something like a Data Users Meeting. I go to those things to engage with USDA, NASS, AMS, ERS, give them some feedback about their products and hopefully make them better over time is why we're there. I'm interjecting it because there are a lot of questions about public funding and market information and so forth. I'm happy to take questions on and try to clarify. And it feels timely to bring that up because I'm sitting here during a government shutdown. There's just uncertainty on a lot of this front. And it also is my segue from my last comment, and we can talk about anything you want, is the consumer fundamentals of demand are quite strong, hinging on the taste. The biggest risk to beef demand, in my opinion, is macroeconomic consumer income driven, okay? The biggest risk to a producer that's not demand driven is the supply side and our ability to monitor and measure things and be aware of what's going on, right? So the January and July cattle inventory reports give us a pulse of that. Even the drought monitors give us a pulse of those things and so forth. And I would submit to you a lot of people, including the financial industry, sort of take a lot of those data and information points for granted, and they're probably not as quite as safe and secure as they once were. So I'll end with that and take any questions we might have.
Questions for Glynn?
I may have missed it. How much of the industry do you think is fully participated in risk management, I guess, is hedged out? I know you touched on a lot of cash from the front to the end, but
I don't know if they can hear it up here, but the question was, what's the, they can or can't? Very good. All right. I think the feedlot industry is quite exposed and in various forms of price risk management. Now that's not just CME hedging, right? I mean, so I would argue even being on formula and forward contracts is a version of mitigating your risk, right? So how you go about doing your business mitigates some of the whipsawing that was in my exercise. And I would tell you that's quite common, like north of 2/3 of the fed cattle, right, in the feedlot industry. But as you go down towards cow-calf, prevalence of price risk management declines pretty quickly. The backer stock rounder effort would have more than the cow-calf, right? Part of the benefit for those segments is the production cycle is short, and I can do some pretty, how do I say, careful, or I can execute price risk management in up to a 12-month window fairly cleanly off of CME products because we treat feeder cattle out to 1 year. For cow-calf, that's a lot harder. If I'm running a cow with an 8 to 12-year production cycle, it's like traditional price risk management on multi-turns doesn't exist. I could hedge one calf crop, right, at a time, and there are producers that do that. Use of LRP has probably been the growth area, like more people doing that today than they did 3 or 4 years ago before the subsidy grew on those products. But to put a bow on my response, there's much less price risk management occurring at cow-calf than there is in the middle for stocker backgrounder than there is at the feedlot stage. And I would say that's always been the case. The only part that's different today than maybe 5 years ago is the cow-calf sector is a little bit more protected because of the grown popularity of LRP.
So you talked on how demand is really strong from a taste standpoint. What are your thoughts on what we're seeing with the trend regarding protein and the importance of it, both from a health and kind of fitness standpoint? Is that just a trend right now, or do you think that's something that we'll see more positive for the beef market?
Yep. I don't think it's unique to beef is my first response. So one of the phrases I've used more than anything else in 2025 is proteins having a moment. So Google cottage cheese. I mean, there's other examples outside of meat, right? So protein is in, right? It's connected in part to the GLP-1 discussion. I don't want to use the term fad or trend there. I don't know yet, but the typical person on GLP-1 is actually consuming fewer calories, but more protein because they're squeezing out other quote unquote bad calories. But in the short term, that's been good for the meat industry. And we've talked about that, and there's MDM reports on that and so forth if you have an interest in it. But I don't think it's only GLP-1s. I think it's more than that, particularly those under 40 that are very active. So whether it's weightlifting or running or whatever it is, are very focused on consuming more protein than their parents did at that age. That's pro-meat protein. So protein is in 100%. So it's more than just a taste comment. I 100% agree with your call out there. Going forward, how long will that last? Each part of what I gave you probably has a different uncertainty. What's the insurance arena for GLP-1s is a really important thing to understand because it changes the cost access point for folks. So to the extent that's really giving us a boost, that's at risk is the point. But I think the broader trend about people wanting more protein in their diet probably is not going away tomorrow, right? So that could have some long legs, but I don't think it's unique to beef if you heard me, right? It's all the major species and the dairy industry in various ways, hence my cottage cheese comment.
Do you have questions online, Rich?
So is the demand mostly domestic? I mean, we haven't even talked about the outside markets yet, or you didn't mention them, so.
Yep. So I did and I didn't. I'll clarify. So the per capita consumption, it's useful for me to clarify what that is. So it's domestic production plus imports minus exports divided by the size of our U.S. resident population. So it's trade is embedded in what I talked about there. And that's important because the only way we're accomplishing keeping that per capita consumption number up is larger imports. Like right now, that's what's done that so far. And we can, if you get more questions on that, we can do that. But that's the part that's like offsetting the domestic production decline. But the other part of that is export demand has fell apart. And I made the comment yesterday, is everything good that I told you on cattle prices? I actually think you could add $100 value to every steer if we had a different, or dare I say, a more normal relationship with China. So the loss in demand for U.S. beef from China and what we're seeing right now is worth at least 100, and some would say $150 per steer. So maybe $10 a hundredweight in the feed yard, right? That's hard to convince cattle producers of when we're in a really good price environment, but I'm trying to tell you it'd even be better if we had a little bit stronger current foreign demand than we do. So it's embedded in what I gave you there. The discussion about imports is pretty political, as you know. But both imports and exports are embedded in my per capita consumption comment there. We could talk about the screwworm. That's not as much about beef trade, more cattle trade, but it obviously has an implication about the domestic production if those animals aren't here, right? So maybe 5% historically of what we produce here domestically originated from lightweight Mexican feeder cattle. So that's a supply effect that we're not going to have here. That'll be a lower domestic production, right, with that one turn. And on balance, Mexico is going to produce more beef, right? So internationally, that shift has occurred.
Staying on the demand front, is there a piece of your demand calculation that takes into account fake meat?
Did you say fake meat?
Yes.
Well, the term fake meat is means lots of different things to different people. Alternative proteins, plant-based patties, there's lots of different subparts to that. To be quite direct, it basically ignores it because it hasn't been a big deal. But I'm going to clarify even further. I've done a lot of work on that topic, some for the Beef Board and other groups, and the peak interest in plant-based proteins specifically, right? So not cell-based and so forth, plant-based that are already on the market. The peak in that was at least 2, if not 3 years ago, right? And just do Google search and you'll see that, and you see it in the stock market and see it in different places. We track actually plant-based patties specifically in the Meat Demand Monitor because when that project was launched early in 2020, it was front of interest to the meat sector more than it is today. But I hope you heard my answer is it hasn't been real relevant. It certainly has not displaced demand and consumption for the typical person at all in the US. It shows up in some of the vegan vegetarian trends that are out there, but the MDM actually tells me the percentage of our country that is a vegan or vegetarian is actually declining. I didn't show you that chart today, but that actually peaked back in late 2021. So the percentage of folks that are self-declaring I am a vegan or a vegetarian is actually less today than it was then as a percentage of our population, which is consistent with less demand growth for those products.
So do you think carcass weights, where do you think they're going to level off at? And is it going to be the new norm to have these heavy carcass weights?
I tell everybody the best way to be wrong for the last 40 years is to say we'll never make them bigger. So I'm not willing to sit in front of you and say we won't figure out, right? And in particular, when grain is cheap, there's an incentive to try. And we have too much physical capacity at the packing sector. And we do, by the way, at feedlot and other parts, right? We have more physical hooks, concrete capacity than we have cattle, right? And that statement's not going to change anytime soon. And that tends to send the signal to get as much beef on that animal as I can in that environment, right? So you have those forces that say we ain't done pushing yet, is what I'm trying to tell you. There is a live and well discussion on the biology front, like how big can we make them and so forth. That's not my area of expertise. But at the end of the day, you heard my first comment, is for multiple decades, we've found a way to do it. So I'm not going to stand here and tell you we're done accomplishing that.